Live from Washington, D.C. for our audience worldwide, I'm Jonathan Ferro. Good morning to you all. The countdown to the Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from Washington, coming up, the latest inflation data, keeping a May hike in play. As the division begins to emerge between Fed officials, equity markets picking up, going into bank earnings. We begin with the big issue, inflation in America.
It's about inflation.
CPI data.
CPI.
Very interesting.
We are at this key point.
We've seen inflation be a concern.
A push and pull battle.
Between the services side inflation, higher rents.
And that's really going to set the tone.
We're still a long way from 2% at this point. Look, the Fed wants to hike.
The market has priced out so many rate hikes.
We think there are too many cuts priced in.
The labor market is still tight.
It seems hard to see a scenario where they're pausing.
But it's really torn because it's got these obvious troubles in regional banks.
They will have to go 25.
The best thing we can hope for is a pause.
You have to be careful what you're wishing for.
I don't think this makes the case for a pause in May.
I'll touch base with Mike McKee in just a moment. I want to kick things off with TD's Priya Misra. And Priya, get your thoughts on what we saw about 31 minutes ago.
Sure. So I think inflation remains solid. Core inflation came in at 0.4. But I think the forward-looking indicators, what we were looking at was the details of the report. Shelter inflation came down, and we've been waiting. I think the Fed's been waiting for shelter inflation to respond to lower home prices as well as lower rents. So I think the market's looking at forward-looking indicators. Inflation has peaked. It's still high, but it's starting to moderate. And once shelter turns, it's a very large component of core CPI, headline CPI, PCE. It also tends to be a very trending component. So I think what we took comfort in was that the shelter component has started to turn lower. This implies some of the pressure on the Fed. Now, we do think that they're going to go another 25 in May, perhaps another 25 in June. But I think the pressure that had been building up on the Fed with shelter inflation remaining high, ex-shelter CPI services remaining high, some of that pressure is easing away. And I think that's why the market's responding. You know, the market's still sort of torn around that May hike, and I think they'll go. But it's really what happens after that. And we do think that the other issues, the banking credit crunch, as we're calling it, is going to compound the impact of rate hikes. The economy is going to head into a recession. The Fed's going to be cutting by the end of the year. But I think today's report, at least it tells you that a big component of inflation that had just propped up core services inflation for so long, that's starting to turn. Hard to say how quickly it's going to turn. First sign we've had, but it's the lowest shelter reading in a year. So I think that's at least comforting to risk assets, because at least it's telling you that that one constant source of pressure on inflation and the Fed is starting to ebb a little bit.
Priya, just to be clear then, you see reasons for the two-year yield to drop by the 10 basis points it's dropping by this morning?
So the 10 basis points by itself seem like a lot. But I'll tell you, I think the market reaction to all data surprises is going to be asymmetric, meaning if we get weak economic growth data, weak bank earnings, or weak inflation, I think we react a lot more because, you know, I think the market's looking at when is the Fed done? When does the cycle turn? The market's always forward looking. So I do think that data surprises will have an outsized reaction when it's a little weak. So in that context, the 10 basis points doesn't seem that much. And here's another way to think about is that 10 a lot. The market was pricing in before the report 3% on Fed funds by the end of next year. You know, if inflation is decelerating, if the economy is heading into a slowdown, I think 3% is highly optimistic. If the economy is slowing, we're in a recession next year, I think there's a case where the Fed's cutting a lot more than 3%. So that's why, you know, I wouldn't push back. It seems like a big reaction for the fact that core inflation is still strong. But if inflation pressures are moderating, and I think we remain very concerned about the impact of the bank credit crunch on the economy, then 3% Fed funds is too high. So I think that two-year rate has a long way to go before it prices in a true hard landing scenario.
Priya, it's funny you say that because it echoes something that Neil Dutta of Renmax said as well. Either we've priced in too many rate cuts or not enough. There's kind of no in between if we really face a banking issue. Is that the kind of idea that you're trying to get across as well?
Exactly. And I think the market prices in weighted average, distribution of outcomes. I think it's a very, what we're calling a bimodal distribution. There's the view of a soft landing. The Fed gets to 5.25, 5.5, wherever they end. And then very slowly over the next 2 years, they get to some neutral 2.5 or 3% rate. And then there's the scenario that we're in that camp, that the economy slows down substantially and the Fed starts to cut rates, but they cut a lot more. I don't see an in between. I think these are the two scenarios. Every data point is changing the probability of these two scenarios. And today, with a slight, at least the fact now, if today's report had been driven by some one-off category, I wouldn't have read much into it, but it was driven by shelter. And we've been waiting for shelter to start to respond to the fact that home prices are falling. So I'm taking this to be a sign that shelter's turning. And so if the inflation pressure is lower, growth starts to weaken, I think you're supposed to put greater odds on the scenario that the Fed is cutting perhaps later this year or early next year, maybe not very soon this year, but then cutting a lot more next year.
Priya Misra of TD alongside us. If you just joined the programme, welcome. About 35 minutes ago, inflation data out. Yields dropping off the back of it, down about 9 basis points on a 2-year to 393. Equity markets popping just a little bit, although we've retraced some of that move. We're still positive on the S&P by about 0.5%. Mike McKee breaking down the numbers. Mike, you've had about 2, 3, 4, 5 looks at this. What stands out for you now?
Well, Priya said that the market is forward-looking and wants to know what the Fed is going to do next. I think this keeps the Fed on the path to a 25 basis point move on May 3rd. But after that, it's still very cloudy out there because, as she noted, we saw a big drop in headline inflation, which was largely energy and food price driven. Energy prices falling significantly, especially gasoline and natural gas. But the core barely moved. And that's because the weight of housing is so great. Even though it ticked down by 1/10, it's still pushing up the overall indexes. And you can see the core rate went up during the month of February to 5.6% from 5.5. Now, why is that? It is shelter, and shelter is likely to be coming down. It's a question of how fast. Now, here's the CPI core services ex-housing. This is the number that Jay Powell is touting. Take housing out because of its weight, and you can see that we've got a significant decline going on both on an annual and a month-over-month basis in services inflation, which the Fed says is where we're really getting inflation these days. So what does it mean for the Fed? Well, a lot of Fed speak in recent days, and basically what you've got is a division but not a real disagreement. There are a group of people on one side saying, yes, definitely pause after May. Pat Harker and Neil Kashkari, two of the latest there, and also Austin Goolsbee in one of his debut speeches signing on to that. And then the other group says, well, let's pause, but we'll see what happens after the next meeting, and if we need to do more, because we are determined to get down to 2%. And I would point out, John, one last thing here. If you take a look at the dot plot, yes, the consensus was for a 5.1% terminal rate, effective terminal rate, which would put you at 5.25. But look at above that. There are 7 dots of people who think that they are going to have to go higher. So it's going to remain a live possibility, even with inflation coming down a little bit.
If you get the opportunity, and this is not for you, Mike, just for the audience, and you haven't done this before, go to the summary of economic projections that the Fed delivers every quarter and have a look at the range, not just the median. Have a look at the range. It's really quite wide going out the next couple of years. Mike, great reporting this morning, as always. Mike McKee's going to be with us down in Washington, D.C. through the week to cover some of these issues. Bank of America just put out a note looking ahead to retail sales. They say a March malaise. They say the following: the sequential slowdown in spending after the surge in January creates meaningful risk of negative GDP growth in 2Q. That's the latest from Mike Gapin and the team. I'm pleased to say we can continue this conversation. Jumping on the line for us, Colin Martin of the Schwab Centre for Financial Research, fixed income strategist. Colin, the latest from the Federal Reserve. I want to start with this note here from Goolsbee of the Chicago Fed, who came out with a really interesting speech yesterday. Mike McKee called it a debut speech. He said, at moments like this of financial stress, the right monetary approach calls for prudence and patience for assessing the potential impact of financial stress on the real economy. Is that what you expect, Colin, this Fed to embrace?
You know, I think so. And what I liked about his speech, he was pretty open and clear about his views. And I liked how he even commented on the potential impact. He kind of quantified the impact of tighter bank standards and what it means. And I think what's interesting, if we look at that graphic that Mike put up before of the range of Fed speakers, none of those outcomes, at least in the near term, discuss a cut. And I think that's important when we look at the Fed versus the market expectations. I do think they'll hike in May. This morning's report, I don't think that'll change anyone's views. I guess it was a step in the right direction. But if you look at core CPI, that's still way too elevated. I know that's something that they pay a lot of attention to. But going forward, they wanted to continue to move lower. But before we get to the potential, discussion of cuts, we don't see too much out there. I mean, we're starting to see some cracks in the labor market, but just slightly. I mean, the report last week with non-farm payrolls, it was, yes, the smallest gain in a few years, but we're still seeing the unemployment rate at a multi-decade low. So I think we'll have to wait and see. I think when we're putting a lot of weight to Goolsby's speech, where they should hike, but then see what plays out from there, understanding that there are long and variable lags, and we're still just a year into this.
Priya, we've talked about the 10-year with you repeatedly. I believe you've been long the 10-year since 4%. We're down to about 340 right now on the 10-year, 337, 338. Between 4 and 340, there's been a ton of volatility in between. Priya, are you sticking with that long on the 10-year?
I am. I mean, am I pounding the table that this is the time to put all your chips on the table on the long? No. We took some profits, but what happened between that 4 and 340 actually increased our conviction on the slowdown. I think we were in the slowdown camp. The catalyst that can make it into a deeper recession is the tightening in bank lending standards. And these are very non-linear effects. So I would agree with Sean, the point that the Fed or with Goolsby, the Fed, I think the threshold for them to pause is not that high because of all the uncertainties. We were already worried about monetary policy lags. Now we're looking at the banking system. Pause, but then do they cut? Can they be preemptive? I think inflation is going to not let them be preemptive. And so what the 10-year does is it allows you to position for the slowdown without being as particular on when does the Fed start to cut rates. It's much more longer term. I would say 5-year or 10-year is still attractive if you're not sure when inflation will allow the Fed to respond. I think when the Fed starts to respond, you should be in the 2-year. But I don't know if now is the time, because inflation, as we just noted, it's still high. Wages are still high. The labor market is strong. It'll turn. We just don't know when. So I would say being further out the curve, 5s or 10s, you're positioning for the slowdown that I think the bank deleveraging is going to make much worse than just monetary policy tightening would have.
Priya, the latest data we've seen so far, we had a string of misses last week, and this is a question that a lot of my audience, a lot of our viewers have reached out to us about. They want us to ask people like you, what do you put more weight on last week, the misses or the payroll story, or the lending data that came out later that afternoon on Friday?
I think that just tells you, keeps us all busy and somewhat sleep deprived. We have to look at all of this data. I do think what we look at is the more leading indicators, maybe a little bit more than payrolls or CPI, frankly. Unfortunately, the dual mandate of the Fed is the most lagging indicators out there. So I would pay attention to the lending data. I think that's telling us, future credit creation. And I was most concerned with the ISM services picture. If the consumer is slowing down, and is that because of rate hikes? Is that because of the savings buffer going down? All of that. I think that, to me, is the first sign. If consumer spending slows down, and we're going to get retail sales, we expect another weak report. I think that's going to make the market more nervous about the move from goods to services. If the service momentum is starting to slow down, that's going to feed through into the labor market at some point. It just could take some time. So, but I think the misses, to your point, it's slowing. The pace of decline, I think we need more data to see, are we slowing into a recession, or are we just slowing to trend growth? In our view, we're slowing into a recession, but I think that only time will tell.
Priya, Colin, stay close. We'll continue this conversation. Looking at the bond market right now, we give up some of the initial move off the back of that CPI report. We're still lower, though, at the front end by 9 or 10 basis points on a 2-year. We come back down to about 390-ish. That equity market lift, it sticks, just not as pronounced as it once was. We're still positive by about 0.6%. Let's get you some movers going into the opening bell. Let's do that with Katie.
John, American Airlines under pressure this morning after the company said that first quarter profit will likely disappoint, expected between 1 to 5 cents a share for the period. That's according to a filing. Again, that's below the analyst estimate. Moving on, we do have some M&A movers. Brookfield is buying Triton Infrastructure for about $85 per share, stock up about 10%. National Instruments also on the move. Bloomberg reporting that Emerson Electric is nearing a deal for the company. That's according to people familiar with the matter, John.
Katie, thank you. Coming up on this programme, counting you down to the opening bell, about 15 or 16 minutes away, Secretary Yellen shrugging off economic concerns.
The U.S. economy is obviously performing exceptionally well. I'm not anticipating a downturn in the economy, although, of course, that remains a risk.
That conversation up next.
I've not really seen evidence at this stage suggesting a contraction in credit, although that is a possibility. The U.S. economy is obviously performing exceptionally well with continued solid job creation, inflation gradually moving down, robust consumer spending. So I'm not anticipating a downturn in the economy, although, of course, that remains a risk.
Treasury Secretary Janet Yellen playing down recent turmoil in the banking sector. The IMF sending a very different message.
Some of these pockets of vulnerabilities could spread. What we are seeing right now is the risk that banks are going to look at the outlook. They're going to look at their bottom line. They have to pay more for deposits. They're losing deposits. They're booking losses on the asset side, on the holdings of long-dated fixed income assets. And that could weigh down further on economic growth, both in the U.S. and in the rest of the world.
This coming as the biggest banks prepare to reveal how their deposits fared. We'll get numbers from them a little bit later this week. Analysts estimating a $521 billion year-over-year drop from JP Morgan, Wells Fargo and Bank of America alone. That would make it the largest decline in a decade. For more, Bloomberg's Anne-Marie joins us right down here in D.C. AMH, can I just say a little bit of daylight between Secretary Yellen and the IMF?
Just a little. I think there's a lot, Jonathan. What you're seeing is the Treasury Secretary having a glass half full moment, while Kristalina Georgieva is really glass half empty, especially when it comes to the global economy. Secretary Yellen yesterday said we need to stop with this negativism. Why are we not being more positive? One of the key tensions, besides the banking industry and obviously the rest of the world feeling what the Fed is doing, which is an aggressive rate hiking and how that impacts banks' bottom line, not just the United States, but around the world, but globally, this idea of a fragmented economy. Kristalina Georgieva talked about the geopolitics of this and how fragmented economies and this pressure on the geopolitical world can mean lower growth. And what she's really talking about there is this U.S. policy of friendshoring, of nearshoring, specifically when it comes to China. And Secretary Yellen yesterday came out and she said that point has no validity. So you're going to see a lot of this back and forth as we have the IMF meetings continuing this week.
AMH, the Treasury Secretary, sounding more and more like a politician down in Washington. Priya Misra, Colin Martin back with us. Colin, was that the politician, Secretary Yellen, or the economist when she said she's seen no evidence of contracting lending?
I'd say that was the politician, because the evidence of contracting lending is pretty clear if you look at any of the data from the Federal Reserve. So when we look at that debate, we side more with the IMF, where there are plenty of cracks forming. And this was a question you posed right before the break. We are seeing this, whether it's the ISM manufacturing, ISM services. We saw it yesterday with the NFIB small business optimism in terms of plans to hire. So we think there are a lot of cracks forming under the surface, but it really does all come down to bank lending. And I think that's very important right now. I'm sure most of your guests are talking about this. But if we go back to that senior loan officer survey that we got a few months ago, that was from the fourth quarter of 2022. And we were already seeing signs of stress in terms of tighter lending standards, reduced demand, higher rates, things like that. Now, because of the bank failures and the bank situation, I think that's only likely to get worse. Now, just because we're not expecting more failures or we think this is going to be a full-blown banking crisis doesn't mean that there aren't negative consequences. If the Fed is reducing its lending, that's just taking money out of the system. So we do see that as a risk going forward. It doesn't mean that we're seeing a recession in the next month or next quarter, but we would expect over time to see that impact result in slower growth.
This phrase data dependency, I think a theme for us this week, over the last month, has been dependent on what data. And if we put more weight on maybe the less traditional indicators like the bank lending data than, say, CPI and payrolls. This is what Priya and I were talking about moments ago. Priya, this is what I got from Stuart Kaiser over at Citi. This is his view on the situation following the inflation print from an hour ago. The CPI is not as positive as the equity market move. Investors have not yet been jarred from the view that inflation is on a sustainable downward trend despite recent data, but we expect the Fed to cajole markets into more hawkish pricing. Now, Priya, based on what you've told me so far, I imagine you're pushing back a little bit against that view.
Yes, because I think the Fed sees all the headwinds to growth here. You know, and remember, rates are high, and they're going to probably hike one more times in our baseline call, perhaps two more times. But I think just looking at inflation is tough. They've got a dual mandate. They have to look at the employment side, and they have to look at the headwinds that are building. And some Fed officials are highlighting that. This is slightly different from the Fed 6 months ago. That was, I would say, had a one mandate. I think we've moved from single mandate to looking at how do they get full employment and why, and should they not overdo it? You're hearing this "let's not overdo it" phrase come up a lot more. Doesn't mean that they're getting ready to cut rates, but I think the threshold for them to pause at some point and then wait and see the pace of deceleration. And if it is like how Secretary Yellen talked about it, downturn but not recession, they can keep it there. They may have to cut if it looks like a much deeper decline. So I would say, yes, inflation's decelerating, it's high, but there's a lot of other things that the Fed is considering, given that they've tightened very fast. And when you take real rates that high, and 10-year real rates are still well north of what we think is our star, something's breaking. I think we're in the process of something breaking. So I think they have to be concerned. And we're hearing that a little bit from Fed speakers.
Well, a few things broke last month, that's for sure. Priya, Colin, always too short. We're going to have to catch up again soon. Priya Misra, Colin Martin, to the two of you, thank you. The range of views out there at the moment. This from Neil Dutter. That CPI report, fodder for the soft landing bulls. I'll pick up on that in a moment. Coming up in the morning calls and later, why JP Morgan's David Kelly expects multiple rate cuts in 2024. Equities positive going into the opening bell. Let's get you some morning calls. First up, Baird downgrading Lockheed Martin to neutral, expecting supply chain disruptions to drive mixed quarterly results. Your second call from JMP, upgrading Shopify to outperform, pointing to strengthening traffic data. And your third and final call from UBS, upgrading Goldman to buy, saying the firm looks well positioned for rising levels of volatility. That stock up 1%. Coming up, big bank earnings on deck. That conversation coming up next with JP Morgan's David Kelly. From Washington, this is Bloomberg. "23 seconds away from the opening bell this morning. Good morning to you all. Equity futures positive by 0.5% on the S&P, a lift on the Nasdaq. The Nasdaq 100 up 0.6%. CPI, at least for core, basically in line with expectations. For headline, a bit of a downside surprise. A lift in the equity market. There's your opening bell. Switch at the board and get to the bond market. A rally in the bond market. Yields lower off the back of this. The 10-year down 5 basis points, 338. The 2-year down 8 basis points, around about 395, and the dollar a little weaker. Euro stronger, approaching 110, 109.78 on euro dollar, positive 0.6% there. Crude at about 82.20 on WTI, with positive 0.8%. We brought a story for you. 20 seconds into the session, a check of the price action on the S&P 500, positive 0.5%. On the Nasdaq, a lift of 6 or 0.7%. One stock to watch at the open, American Airlines, warning that quarterly profits will likely fall short of Q1 estimates amid persistently high cost. Kaylee Lyons has more. Hey, Kaylee.
Yeah, John, the stock down the better part of 5% as trading opens, which at the moment makes it the single worst performer in the S&P 500 this morning on a day when most stocks are higher after inflation. As you said, the issue here is the preliminary forecast, if you will, for earnings does come in a bit light. On average, analysts were expecting earnings of 4.6 cents a share. American says it's only going to be between 1 and 5 cents. So at the midpoint, clearly that falls short of estimates. Now, on the top line, revenue was mostly in line, just a touch late. They're guiding for $12.19 billion. But we know what the story has been with these airlines, John. Post-pandemic travel demand has remained incredibly resilient, even in the face of inflation and now concerns about a recession. And that has meant airlines have been able to raise fares to pass on higher costs. And once again, we did see that showing up in CPI with airfares up 4%. Month on month. There are signs starting to emerge, though, that consumers are opting for lower fares. There has been some slowing recently in weekly bookings. So the commentary around demand when we actually do get these earnings calls going to be very interesting, as well as the commentary on cost. Remember, United last month warned about higher labor costs, leading to a surprise profit potentially when it reports on April 18th. We get Delta first up tomorrow. American's not going to be reporting until the 27th. But what is it going to mean for a stock that still remains at about half its level it was pre-pandemic?
And had a really good start to the year, some of these airline names absolutely ripping, hitting some turbulence, so to speak, forgive the pun, in the last couple of weeks. Kelly, thank you. The stock down about 4 or 5% at the moment. Let's stick to pricing pressure in that theme. Rising prices also impacting the US retailers. Argus downgrading shares of Abercrombie to hold, writing, quote, Abercrombie has struggled to expand margins amid inflation and currency headwinds, with cautious consumer spending weighing on sales growth. That's the latest call from Argus on Abercrombie, and I'll try and get the stock up on screen for you. There it is. We're down about 2%. I want to turn to tech. Tesla planning another price cut, this time in Hong Kong. That's the reporting from the Hong Kong Economic Times. This as Elon Musk engages in a fiery conversation with the BBC on Twitter. Ed Ludlow in San Fran with more. Ed, let's start with Tesla pricing, and then we'll get to Elon Musk. What's the latest on that front?
Yeah, so there are a broad range of price cuts coming out of Hong Kong across Tesla models. That, according, as you said, to the Hong Kong Economic Times. Not a surprise, you know, a number of analysts have weighed in this week saying that they expect more price cuts to continue as Tesla pursues volume. But then you also have to make the consideration around the impact to margins. Musk has been pretty clear, right, that Tesla is in a position where it's willing to sacrifice margin and profits over a long term in order to maintain growth as near to 50% annual average growth as possible. So the cuts in the US were broad earlier this week. The timing of them was a little bit of a surprise, but the sell side at least expect that lever to be deployed going forward as we kind of chase that big picture for Tesla, right, which is advance the transition of the Earth to sustainable energy.
Ed, should we talk about unprepared journalists engaging with Elon Musk? What did we learn?
Can you see the bags under my eyes? Because I don't know what you were doing at 11 p.m. Eastern last night, but I sat through the 2-hour spaces. You know, a broad range of questions, many of which Musk dodged. I think the health of the Twitter platform was kind of the biggest takeaway. Musk saying that most advertisers have returned and that the financial health of the company improved. He reiterated a previously stated position that the company could be cash flow positive this quarter. He was pushed on which advertisers had not come back to the platform and didn't answer the question. I would point out, John, because I think it's important for Tesla shares. He said that he kind of reiterated this idea. He can only sell Tesla stock within certain windows, and that he did sell a lot of Tesla stock in order to finance the deal to buy Twitter. He was asked if he had any remorse or regret about how many people were laid off and why he didn't just come in to plug the financial gaps, because he'd said that the severity of the cuts was needed to avoid bankruptcy at Twitter. And he basically made the point, I do not want to sell Tesla stock. That was his base position. That was just some of what was discussed.
Ed, thank you, mate. That stock is up by 1.6%. Tesla, the last week, just hitting a weak patch after a really, really decent year to date. Still pretty decent year to date. I can tell you exactly what I was doing at 11 p.m. Eastern last night. Sleeping a few hours after the football ended. This email came in the last hour, and I promised I'd mention it on air. How are you? Can you say something nice about Man City on the show, please? So this was me saying something nice about Man City on the show. I'm pleased with that. Sticking with tech, Chinese giant Tencent falling by the most in 2 weeks as signs emerged that its biggest shareholder could keep selling. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, Tencent fell more than 5% in Hong Kong trading after news that maybe Prosus is not done selling. They filed to deposit an additional $96 million worth of shares into Hong Kong's stock clearing system. Typically, that precedes a sale, and Tencent shareholders definitely seem to think that's the case, just judging by the price reaction. Now, as of the most recent filings, Prosus is still by far Tencent's biggest holders, as you can see, with a 27% stake. That number had been as high as 29% last year, but the next largest shareholder ranks as at 7.4%, followed by Vanguard's 2.5% stake. Now, Tencent's fall on this Prosus news comes after a huge rally. You can see that shares are still higher by more than 80% from October's low. That's even after Prosus started to pare back its holdings in June of last year. That was to fund its own share buybacks, and the Prosus CEO said that that process is open-ended, John, so we'll see if more sales are truly on the way.
Kelly, thank you. That stock is down by 3.8%. Let's turn to the banks. That's where the attention is going to be through the rest of this week, particularly on Friday with JP Morgan on deck. Shares of UBS higher. There is a stalemate in Swiss Parliament over state guarantees for UBS's takeover of Credit Suisse. Shonali Basak has more. Hey, Shonali.
Hey, John, you're looking at a stock, UBS, up about 10% on the year after this Credit Suisse deal really has boosted its prospects across the street to be a global behemoth. But, of course, there's this massive dispute within the Swiss parliament about those guarantees given by the government to get the deal done. Now, this vote is largely symbolic. It is largely political, and it regards around the more than 100 billion Swiss franc guarantee the government had given. This is $120 billion we're talking about. So the thing ahead here is the concern that the state guarantees, and I'm using the words of a Swiss People's Party member here, that these guarantees fuel a narcissistic company culture among bankers. Now, this is a lot of anger that remains from 2008. The question here is among future guarantees. Of course, here in the United States, we're talking about guarantees as well when you think about the struggles the banking system has faced and where the government needs to step up. But certainly in Switzerland, there's a lot of pain being felt among Parliament about not only the guarantees that are being offered for this deal alone, but the future strings attached with the banking system as you have lawmakers really discussing here stricter rules and restricted bonuses that would come for the bankers involved in this deal.
This saga, this drama, a never-ending story. Shonali, looking forward to your coverage on the banking sector through the week. That's going to pick up towards the end of the week and then continue through next week as well. About 8 minutes into the session, we're positive 0.6% on the S&P. On the Nasdaq, up 6 or 0.7%. The inflation report, about 68 minutes old now. David Kelly at JP Morgan has this to say. The Fed will cut multiple times in 2024. The prospect of lower rates should help support both bonds and stocks, although it could also allow a continuation of a lower dollar trend, benefiting investors in international equities. David, I'm pleased to say, joins us now. David, thank you for your patience. You have the benefit of time on your side. You've had about an hour to look over this inflation report. Let's start there. Are you seeing encouraging signs that disinflationary trend that Chairman Powell hoped had started? Is that process continuing?
Yes, it is, and I'm not sure why anybody doubted it. I mean, if you look at the history of inflation, it follows Newton's law. What goes up must come down. And we were at 8.9% year over year last June. We're down to 5% year over year now in March. As we track the numbers, we think we'll hit 4%, actually below 4% by June of this year. It might be like 3.8. It'll stabilize then for a while, but by the end of next year, it's going to be down to 2% year over year and falling on the CPI inflation rate. So we didn't see core inflation come down, but we did see food and energy come down, and that could feed through to lower core prices down the road. So overall, I think it's a very encouraging report. I don't know why anybody's surprised. I think we've seen this has been in the tea leaves for a long time. But hopefully the Federal Reserve pays some attention to this and realizes that inflation really is coming down.
Do you believe, David, then the Fed might be done, or at least very close to being done?
Well, the futures market is very close to this one. It was betting, about a 65 to 70% probability that they'd do one more rate hike in May before the report. After the report, those odds have come in a little bit, so I suspect it's close to a 50-50. It depends. I think if anything else goes wrong, if there's any negative sign whatsoever on the economy between now and the May 3rd report, or the May 3rd meeting, I think the Fed's done. They really should be done right now. And I think the committee itself is somewhat split. If you're somewhat split, it would kind of make sense to pause and leave yourself the option of raising rates in June. So if I had to bet today, I think they'll pause, but it's a very close call. I know they should pause, but it's a close call as to whether
David,
they
you
will.
mentioned your forecast. Let's talk about your calls. You said south of 4 potentially on inflation by year end. I'm looking a little bit further out, and your call suggests maybe 2% by December of next year. And then you say this, the potential for further declines from there. Now, David, I've been told for months by many people there should be a secular component to this higher inflation story, that maybe it's going to be stickier. Do you really believe that maybe that's not the case and that we can get below 2 all over again?
Absolutely, because the number one thing that I'm looking at is the fact that wage growth has been below CPI inflation for 24 straight months. 94% of the private sector workforce in America is not unionized. They ought to be arguing for higher wage increases, but they're not. They're happy to get what they can get. The economy itself is going to be weak. And if you get wage growth to slow down, then all those long-term forces which were pushing inflation down prior to the pandemic, things like information technology and markets, great inequality in income, declining unionizations, all those things will still be in play. And I think this is fundamentally a disinflationary economy. I think that was interrupted by extraordinary fiscal stimulus in the midst of the pandemic, but I think it'll reassert itself. So, I think it's back to the future. I think by the middle of this decade, the inflation story is going to be exactly what it was in the middle of the last decade.
So are we saying that we're back to the 2s? Inflation at 2, GDP at 2, and maybe even rates at 2. Are we going back to that?
I think I'll take the under on the first two numbers. I think we're going to go below 2% on trend GDP growth. I think trend GDP growth is only 1.6, 1.7% in this country. I think inflation will come down below 2 also. I think on rates, though, the Federal Reserve hopefully will stop in the middle. I mean, there's nothing has really helped by pushing rates down to a zero lower bound. All that does is it creates asset bubbles and distortions. It doesn't really stimulate the economy. So I think the Federal Reserve will cut rates throughout 2024, but I think they'll probably stop off at somewhere like 2.5% of the federal funds rate on the way down. I don't think they're going down to zero. But slow growth, low inflation, that's I think where we're headed.
Can I just jump in on the market call then and try and reconcile this with your view on international equities? David, why wouldn't this just lead to the return of US outperformance and US equity market dominance led by tech?
Well, first of all, very slow growth, I think, is going to hurt US performance because I think you're going to see faster economic growth overseas. I also think that the inflation problem could be stickier overseas. I mean, as we talk to our European economists, they're not nearly as optimistic as I am on inflation, and probably for good reason. I think wage growth will be stronger in Europe. And if that's the case, then, I think the European Central Bank will probably stay tighter for longer. I think that's probably also the case for the Bank of England. So you'll have a situation where the Federal Reserve, having overshot its cutting rates, the ECB and the Bank of England are keeping rates high. That should push the dollar down. And if it pushes the dollar down, it should lead to international stocks beating US stocks. It is true that lower rates could help tech stocks in general, but I think that bigger trend of a lower dollar will probably dominate here.
Dollar's weaker this morning, that's for sure. Dollar index back to about 101. David, enjoyed this, as always. David Kelly there of JP Morgan on the latest inflation data, where he thinks this is all heading, which is kind of back to where we were pre-pandemic, which is also the view of some people at the IMF. I know a lot of people watching this programme take the other side of it, but that's just the range of views right now. Big range of views on the big arguments of the moment. On the S&P 500, 14 minutes into the session, we are positive a third of 1%. This move fades just a little bit on the Nasdaq. We're up by about a third of 1%. Coming up next, inflation in America showing signs of cooling.
Lowering cost for the American people is a priority for him, and he'll continue to certainly do that.
What the CPI print means for the Biden administration, that conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, UK Chancellor of the Exchequer, Jeremy Hunt. That's at 4:30 p.m. Eastern, 9:30 p.m. in London. This is Bloomberg.
When it comes to lowering cost for the American people, this is, as you know, something that the president, when you look at his economic agenda, when you look at his economic policy, lowering costs for the American people is something that is at the center of that, is a priority for him, and he'll continue to certainly do that.
A key inflation print keeping a May rate hike from the Federal Reserve well in play as the White House continues to grapple with rising prices. AMH back with us here in D.C. with more. Hey, Anne-Marie.
Hey, John, we're still waiting for the White House response on this, but you can imagine what they're going to do is just cherry pick the data that makes sense for them and their agenda. So they're going to look at the headline, the inflation at 5%, a tick under forecast, and they're really going to want to lean into the two things that affect Americans. Many Americans drive, energy prices are down, and also grocery stores. Everyone goes to the grocery stores, and food prices are down. So this is kind of the data I can imagine the White House is going to want to tout today. The issue obviously have is the core that remains elevated, and also, as Mike McKee and I were talking about earlier, gas prices are actually on the rise, and this is happening ahead of peak driving season in the summer, and many are pointing to what OPEC Plus just did, which is taking some supply off the market. So gas prices potentially in the next few months could become another headache for the administration.
I have no doubt we'll get a White House response at some point in the next couple of hours. Anne-Marie's going to bring that to you. Allow me to bring you to the price action just briefly. This market not as enthusiastic about what we saw an hour and 20 minutes ago. The initial reaction, equity futures were higher by about a 1%. Yields were lower by more than 10 basis points. On my screen right now, the S&P 500 just about positive still by 0.2%. 20 minutes into the session on the Nasdaq, we are just about positive, and at one point turning negative. In the bond market, that move fades as well. Yields are still lower by 6 basis points, sub 4% just. The 2-year 396, the 10-year down about 3 or 4 basis points, just sub 340. More economic data and Fed speak still on tap this week. You'll hear from Mary Daly of the San Francisco Fed. She'll speak at noon Eastern, followed by the Fed minutes a little bit later on this afternoon at 2 p.m. Eastern time. Mike McKee, those Fed minutes, how important are they going to be a little bit later this afternoon?
Well, the problem with the Fed minutes is that they are always 3 weeks old, and so a lot happens between now and then. We're going to be looking primarily at what they were thinking of the banking situation at the time, because you remember we went into that meeting with SVB and Signature Bank closed, and a lot of concerns about whether this would be a broader banking crisis. So we'll get their views on that and get their views on where inflation was going. But we've heard from Fed officials over the last 2 days about how they think the banking crisis has settled down. Now, they can't cherry pick numbers, as the White House may, as Anne-Marie was saying. But you look at the chart here with the red line, that's when the Fed started raising interest rates. And, yeah, inflation has come down, but unemployment has also come down. And that wasn't supposed to happen. It's not matching their forecast. So one of the questions for them is, why is unemployment staying so low? And is there a danger it's going to suddenly shoot up, given all the layoff notices and given the tightness of the Fed's policy at this point? As John mentioned, we got Fed minutes today, but then we still have some other important numbers this week. We have jobless claims and PPI tomorrow. Jobless claims, in part, or in large part because of seasonal adjustment, jumped last week. So is it technical, or are we seeing a sustained rise in claims? Be a lot of interest in that. Retail sales on Friday, and I heard, John, you talking about it earlier, there's definitely some negative outlooks from some of the banks about consumer spending during the month. And then we go to the end of the month, we get income spending and the PCE index ahead of the Fed meeting. And that isn't as much data as we had before the last one. So we're going to have to make a lot out of what we get.
That gloomier view on consumer spending echoed by Bank of America and Mike Gapin a little bit earlier this morning. Mike, thanks for that. I'll try and bring you as much research as I can from the South side. This from Ellen Zettner and Morgan Stanley, who say this morning: a slight slowdown in core inflation with significant deceleration on core services should be a positive signal for the Fed. They go on to say that shelter inflation still has to show more signs of turning decisively. The ultimate conclusion, though, for Morgan Stanley, and many of you I know, we see the data firmly supporting another 25 basis point rate increase in May. That's the view from Morgan Stanley this morning. Let's get you some sector price action. This equity market pop fades just a little bit more. Here's Katie.
Hey, John. Well, the S&P 500, it's only up about 0.2%, but you're looking at a pretty broad rally underneath the surface. 10 of 11 sectors in the green right now. Financials leading the way up 0.5% or so. And then you look to the downside and you have big tech. And big tech has been interesting over the past 4 days or so. It's had a habit of climbing throughout the day. You add that all together, though, it's still lower.
Katie, thanks for that. Your equity market more broadly, as I say, around the CPI report, a decent pop. That face just a little bit more. This week, still a lot more still to come. Mike went through the data. Bank earnings coming up just around a corner as well. Your trading diary up next. The back-to-office push continues. The latest from JP Morgan calling managing directors into the office 5 days a week. MDs back to the office 5 days a week. That headline crossing just moments ago. Allow me to bring you the trading diary just briefly. What you need to be watching this week. The Fed's Barkin and Daly speaking later this morning, followed by the Fed minutes at 2 p.m. Eastern time. US PPI and another round of jobless claims coming on Thursday. Plus, President Biden meeting with his Irish counterpart later that afternoon. US retail sales out on Friday, and the big banks kick off earnings with results from JP Morgan, Wells Fargo and Citigroup, all on deck. From Washington, D.C. this morning, good morning. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.